Rohr here with an early, concise highlight on Friday, October 10th, 2014. And it's going to be quite concise today because we are only covering the equities. The Govey's view remains very much the same as Thursday morning's concise highlight, and not much has changed in the foreign exchange since our Wednesday global view. And there are quite a few macro factors, especially the weakness that continues to spill out of Europe in many ways, that are weighing on the equities, and in a most pointed way in especially Germany. So now we need to ask, well, what does all that mean to the equities? And currently the S&P 500 is off 8 at 1917. And as we don't need to tell you, that puts it just below the recent important equal bottoms, as we had, the 1920 to 18 area support. We held 19, 18, 20 on the sell-off, going back into the second of the month, last week, Thursday. And in the initial response to the weak ECB indications, and also exactly 19, 18, 20 at the lows back on Wednesday before the big bounce on the dovish Fed minutes. But just as an aside, on a macro aside, this illustrates the dilemma with getting bullish equities on central bank accommodation that's being maintained longer than people expected because the weakness is still so apparent out there. At some point, if the weakness is weak enough, bad news can be bad news. So once again, we're looking at 19, 18, 20. If the market spends too much time below that, then the bigger supports down into the 1900 area are likely to be tested. That's ostensibly 1904 to roughly 1896 or so. And all of this weakness is being reinforced by the fact that along the way yesterday, not as the market slipped initially, but you'll notice only once it got back below the 1945 level, again, one of our key levels we've been watching on both the way up and the way down to ask if the market can swing to the more extensive resistance or support in this range. Once it got back below it yesterday, did the hourly and 30-minute MACDs drop out below their lower runaway bands, and that sets the stage for continued weakness. This market would probably have to be at least back above 1935 or so, where it's left quite a bit of recent congestion in order to diffuse the downside momentum. If not, we suspect, especially with the weakness in Germany that we're going to cover in a minute, this could continue lower. And that pretty much does it for the S&P 500 short-term view.